Thank you for joining us today. Hawkins CPAs ranks among the top 200 accounting firms in the nation. With 10 offices in Wisconsin and Minnesota, our 175 employees provide local tax, audit, and accounting solutions to our clients. You can learn more about Hawkins CPAs on our website, hawkinsash.cpa. With that, I have the pleasure of introducing Debbie Denny. Debbie is an accounting services manager in our Green Bay office. With more than 20 years of experience providing bookkeeping, tax, and accounting services to clients, Debbie is also Advanced Certified QuickBooks Advisor for both desktop and online. She also has thorough experience with Sage 50 software. Debbie and I joked earlier that it took about 10 years of this presentation for us to finally have it go smoothly. So, and with that, Debbie has been presenting, annually for close to 10 years. So she's got a lot of experience. She's got a lot of content to cover today. So why don't you take it away, Debbie?
Thanks, Corey. I am Debbie Denny, and I hope that I can get you some good information today. We will be talking about payroll benefits and year-end reminders for 2022 and some of the changes going on for 2023. So with that, let's get started. And again, this is Hawkins by the numbers. Corey kind of hinted at that earlier. So some of the topics we're going to go through are the changes, the W-2 information, some pre-tax benefits, fringe benefits, employee versus independent contractor, the Affordable Care Act, and then just some miscellaneous things. So first of all, the changes. There really aren't a ton of changes this year, which is nice. Let's see, the thing is the ACA, the Affordable Care Act, that's still going on. And then that's subject to end in 2025, and that is the health care mandate. Some reminders is that masking the Social Security numbers on the W-2 is fine to do, except for on copy A, which goes to Social Security, and anything with your state or local governments. You do not want to mask that on there. White collar salary threshold, Form W-4, W-2 e-file requirements, and tax rate changes, maximums, and posters. Like I said, there's not a real lot of changes for this year, which is nice. The Affordable Care Act, again, this is the employer shared responsibility mandate, and just kind of a little bit of information on all of this. It is anticipated that the Department of Labor is going to propose an increase to the white collar salary threshold, making it between $900 and $1,000 a week versus $684, which it is now. Let's see, W-4, they did revise that. So any new hires have to use the new W-4 form. With that W-4 form, there is a website, or on the IRS website, there is a link to find out what your employees should take for exemptions. And that is probably the best way to fill out that form, is going through the IRS website. Social Security mandates that electronic filing, if you have more than 250 employees or W-2s that you're sending to SSA, Minnesota and Wisconsin are both over 10. And here's a key fact sheet. This is the limits for 2022, the prior year, and then 2023, what we're going into. So as you can see, most of the limits went up a small amount. The standard mileage rates have not been published yet, but here are all those limits. And this slide is normally available on our website. So if you don't have your presentation slides in front of you and you want to, quick access the limits, you can just pop on our website. Required employment posters. If you have employees, you are required to have posters that are in plain sight that the employees can see regarding employment law. So there's federal employment posters and there are state employment posters. And you don't have to order them from, a website or somebody sends you an email saying, hey, get your employment posters here. Most times you can just print them out from these websites versus having to buy them. Some W-2 information. The due date for this year is January 31st, 2023 for the 2022 W-2 forms. They have not really changed this year. I should say they have not changed this year. They are subject to a major change in the year 2024. So that'll be for the 2023 year filing, I believe it is. But they're going to go through some major changes from what it sounds like. There is a 30-day extension that you can request to file with Social Security Administration for the W-2s. But even if you request that 30-day extension, you still must provide those W-2s to your employees by January 31st. Unless, of course, you fax a letter to the IRS. And then you might have an extension to furnish to your employees. And normally it's only 15 days that they'll give you, but you need to have a pretty good reason for them to give you a delay. And here's a 2022 W-2 form. And when calculating your wages for W-2s, for taxable wages, there are, let's see here. Let me just show you something here. On the bottom of the key fact sheet, it shows what type of benefits are taxable right here for which type of taxes. So if I look here, I can see what type of taxes that each one of these is subject to. So then when I go down to fill out my W-2, I know my wages are going to be minus any pre-tax health insurance or pre-tax, you could have dental, pre-tax vision, all those type of pre-tax insurance plans if you've got a Section 125 plan. Dependent care is also a pre-tax benefit, falls under the Section 125. Then you have your net taxes. Then from there you subtract out your 401k, and that is your federal taxes. So your 401k is not exempt for Medicare and Social Security, but it is for federal and state. And again, for Social Security, there is the new limit now of $147,000 for 2022, which increases for 2023. But while you're doing your W-2 forms, the maximum amount you should have in that Social Security box is $147,000. Medicare, there is no limit for that. So the net taxable wages for Medicare is going to keep going up and up and up. So once you hit Medicare, there is an additional tax for Medicare. If your employees make over $200,000, anything over that $200,000 gets taxed at an additional 0.9% in addition to the 1.45. And here are the W-2 codes for box 12. There are many, many, many of them. And code DD, I know this was a thing that came out a couple of years back that they added this code for employer sponsored health coverage. You only need to complete that in box 12 if you have 250 or more W-2 forms. You can do it voluntarily if you want to, but that's up to you. Supplemental wages, these are taxed at a different rate. And supplemental wages are wage payments that aren't regular wages. They can be bonuses, commissions, severance pay, back pay, things like that. Things that are listed here, but there's other options too. So just so you know, if it's not part of regular pay, you might have to withhold at supplemental rates. And for federal supplemental rates, there is a flat rate of 22%. It depends when you're paying it. If you're paying it, say a bonus separately, you would withhold as flat 22%. If you're paying it with a normal payroll, then you can just withhold as normal. If you're giving more than $1 million in supplemental wages, then you're required to withhold at 37%. And I wouldn't mind getting a bonus of $1 million. They can withhold that, I'd be fine. So that's federal. Minnesota is pretty much the same as a regular pay period with a 6.25% if you're doing it in a separate payroll. Wisconsin is a percentage. So depending what your annual gross salary is, these are the percentages that you should be withholding on the supplemental wages. 401k, 403b, and simple IRAs, they are pre-tax for federal and state, but not for Social Security and Medicare. 401k Roth contributions, those are an after-tax contribution, so those are taxable. And the total between a 401k and a Roth 401k cannot go over the maximum limits for those. So with the 401ks, you need to make sure that if somebody's got a Roth and the regular 401k, that the limit is does not go over what that limit is on the key fact sheets. If you do go over, the employee is then going to be subject to some penalties. And Form W-2 and Box 13 is the retirement plan. And this is the box that, do I fill it out? No, I don't fill it out. So here's a little chart that says, okay, these are when you check the box and these are when you don't check the box. And this is something that the IRS finds that there are a lot of errors in, is checking the box. So if you're not sure, come back to this slide and decide when you should be checking the box. And if you're not sure, you might need to talk with the person that's hosting your 401k plan or your 403b plan and maybe just get some clarification. Some of the codes for box 12 in the retirement plans is your D is the most common that I've seen for the 401k contributions. Simple plan is an S. See, the Roth contributions are the AA. So these are the different codes you use depending on the type of plan that you're offering. And with your W-2s, what the government does is when they get your W-2 forms with your W-3, they take your W-3 form and they match it against your quarterly 941 forms. So here's a reconciliation spreadsheet. With this spreadsheet is where I plug in my numbers with my 941s for quarter 1, 2, 3, and 4. And then on the bottom of the sheet, I fill in the amounts that are on my W-3, and my differences should be 0. If they're not 0, if you see a big difference, you might need to go back and possibly amend a W-2 or possibly amend one of your quarterly 941s. So just be aware that if you don't have the spreadsheet tying out to your W-3, you're going to get a letter from the IRS and or Social Security saying, okay, there's a matching error. Why aren't these two matching? And then you're going to have to provide them with, what was wrong. You're probably going to have to amend some form or another. So that this is one really good item to keep in your back pocket at year end, just so you can make sure you don't get those letters from the IRS. And this is actually also included in the handouts. There is a sample spreadsheet that's available. So this is one of the tabs on the spreadsheet. Just so you know, there are still the qualified sick leave wages and family leave wages on the Form 941s. And here, my slide is not, okay, there we go. If by chance you are still paying qualified sick leave wages or family leave wages for periods between March 31st of 20 and March 31st of 20 through 10/1 of 21, you can still report those on your 941s. It's very few and far between them that's going to happen. So let's talk about the pre-tax benefits. First of all, you've got your health savings account, your HSA, and that is a pre-tax benefit that you use for if you've got a high deductible health insurance plan. So the high deductible plans for 2022, if you're single, the deductible would be $3,650, or family is $7,300 for the deductible. And for 2023, the deductibles go up. So if you do have a deductible plan that is in those ranges, you can set up your own HSA account. And if you're not having it taken out of your employer's, your payroll withholdings, you can also set up a HSA plan at any bank and then take the deduction on Form 8889 on your Form 1040 when you file your taxes at the end of the year. These are portable plans, so if you change jobs, you can take your HSA with you, and then you can carry those forward year after year after year if there's balances in them. With an HSA, you can't be claimed as a dependent on anybody else's tax return, and you can't be enrolled in Medicare. If you are an S corporation, partnerships and S corporation, 2% or more shareholders, are not eligible for the salary reduction, the pre-tax contribution to an HSA. So if you do have payroll that you're running for a partner or over 2% shareholder, you would have to set up a separate HSA deduction type that isn't pre-tax for them. They can still, put money into it, but it's just not going to be pre-tax. There's a medical savings account. Again, there's a credit on your tax return for that with Form 8853. Again, it's portable. You can carry the balances forward. The qualification is you've got to be an employee of a small employer having 50 or fewer employees. You can be a self-employed person, but you cannot have health or other medical coverage. So this is a savings account, more or less, that you put money into and then you get a tax deduction for. The employee and the employer, the self-employed person, they can all make contributions, although the employer and employee cannot make contributions in the same year. So one year the employer might make them, the other year the employee. So that's just one of the caveats of the MSAs. Then there's the health reimbursement arrangements, HRAs. These are funded solely by the employer. It's a nice benefit. The employees are reimbursed tax-free for the qualified medical expenses. There's no limit that the employee can contribute and can be carried forward for year after year. For a qualified small employer HRA with fewer than 50 equivalents employees, 50 full-time or equivalent employees, there are limits and they are listed on the slide. Then you've got your FSAs, your flexible spending arrangements. So you've got your health, dependent, and adoption care assistance that can be pre-tax also. So the health FSA, it's funded through a pre-tax voluntary salary reduction. The employer and employee can both contribute, and the maximum contributions for 2022 is $2,850. And if the employer is contributing and the employee is contributing, the both cannot go over that amount. And then from those amounts, the employee gets reimbursed for their medical expenses. And the employer contributions to the health FSA, those are not included in your gross income. So it's more or less a tax-free benefit for you. The healthcare FSA has to be employer established. Self-employed people are not eligible. The employer can match up to $500 for the FSA, and the employee can make dollar for dollar match. Employers can also utilize a carryover or grace period, and this has to be under their plan that the employees are going to be able to carry over. In 2022, it's $570, which means that after the end of the year, the employee has 2.5 months after 12/31 to carry forward expenses. So if you incur expenses after that, or maybe you don't have receipts and you turn them in after the last day of the year, you can still get those reimbursed. There is a special COVID-19 relief that gives employers the option to allow employees to carry over their unspent 2021 balance into 2022. So you might have fallen into that at the end of last year. Dependent care, this is if you've got kids in daycare, preschool, summer camps, any type of non-employer sponsored before and after school programs, those would be qualified for dependent care. The limit for 2023 is $5,000. I believe it's the same for 2022. The child has to be under 13 years old or be a special need individual. There was a ARPA bill that raised the contribution limit for 2021 only. With the dependent care FSA, you cannot discriminate, so you have to offer it to all employees. The adoption assistance FSA is a pre-tax benefit again for necessary and reasonable expenses relating to adopting a child. This does have a phase out depending on what your income is. So if you're in 2022, if your income is over $223,410, each dollar over that is going to decrease the amount of adoption assistance pre-tax that you can get. And it also cannot be used to adopt your spouse's child. Then there is, again, we've discussed this a little bit, health insurance premiums. So if you've got a 2% or greater shareholders, I mentioned this with the HSAs, or a partner in a partnership, their health insurance, it cannot be pre-tax. So their health insurance has to be treated as a fringe benefit. So hopefully your software programs can handle that for you. But what it does is for the 2% or more shareholders, the company can pay their portion of the health insurance. You just have to add it back to their W-2s as a fringe benefit. And that fringe benefit is subject to federal and state withholding taxes, but it is exempt from Social Security and Medicare and federal unemployment. If you are discriminating and the health insurance is only provided to that 2% or more shareholder or partner, then it is not qualified from the Social Security and Medicare exemption. So if it goes out to everybody, then the employer can have, or the 2% or partner can have that exempt Social Security and Medicare. Oh, sorry, I misspoke there. Partners do not get wages. So just the 2% or greater shareholder would still be exempt from FICA. And again, the HSAs have the same treatment. Third-party sick pay. Third-party sick pay is fully taxable if the employer paid for, or the employee paid, let's see, if the employer paid or employee paid for the policy with pre-tax dollars. It is not taxable if it was paid for with after-tax dollars of the employee. If it was split, if the premiums were split between the employer and employee, you're going to need to prorate depending on how that split occurred. If it was 25% and 75%, depending on what the split was. If the third-party insurer is not preparing the Form W-2, those benefits have to be added back to wages. So in your software, you can record a manual check, and in box 1, 3, 5, and 16, that's where you would put those, you would add in the third-party sick pay, and you would check the box 13, third-party sick pay box on that W-2. And then there's also a Form 8922, a third-party sick pay recap that the insurer may need to fill out. And here is just a slide on third-party sick pay, not as an agent, and liability transfer to an employer, how you would fill out your W-2 depending on how the relationship is. Now we'll talk about some fringe benefits. So these are some of the fringe benefits that are outlined in publication 15B. There are a lot of them. I'm not going to go through all of these because then we'd be here all day and we don't want that. I'm not very exciting. So just so you're aware though, accident and health benefits, achievement awards, adoption assistance, athletic facilities, there's some de minimis, minimal benefits, dependent care assistance, educational assistance, employee discounts, employee stock options, employer provided cell phones, group term life insurance, health savings accounts, lodging on your business premises, meals, no additional cost services, retirement planning services, transportation, commuting benefits, tuition reduction, and working condition benefits. So if you offer any of these, you want to pick up publication 15B. Go to any website, type in publication 15/B, and you will get the IRS publication, because you may need to treat some of those as a fringe benefit, and meaning you'd have to put those on the W-2s. I'm going to go over some of the more common fringe benefits. One thing with fringe benefits, there is a special accounting rule that came out a few years ago that the employer may treat the taxable non-cash fringe benefits provided in November and December. You can report those in the subsequent year. But that means only if they're incurred in November and December, because sometimes it's hard to get all the, say, mileage logs from employees at the end of the year. So any mileage that in November and December, if you can get everything from the prior years through October, you can actually report then November and December's in the next following year. So that is a special accounting rule, and it's limited to non-cash fringe benefits. Employer provided vehicles are the most common that I see, and that is a vehicle that your employer owns that allow you to use your employer's vehicle for work-related things. But it also, if your employer lets you take that vehicle home, maybe they let you just, here's your company car, do whatever you want with it. while personal use of the vehicle is taxable to you. So that's one thing to keep in mind. And you've got to substantiate your tracking your mileage between business and personal use, or the full use of the vehicle. You can include that full use in employees' income. So normally your employees will track their mileage. There's a lot of different apps you can track mileage with between personal and business. We have mileage logs available at Hawkins Ash, just a little book that you keep in the car, and you write down where you're going for business, where your personal mileage is, and you substantiate it. That way, at the end of the year, you're not getting taxed on all of your mileage for the vehicle, just your personal. So there's different valuation methods to calculate what is going to be the add back to your W-2, the general valuation method, and then there's 3 different special valuation methods. So the general is just a value the employee would pay to a third party in arm's length transaction to buy or lease the vehicle. So that's how you get the general value of that vehicle. Then there is a commuting rule. So the employer can take the personal use of auto at $1.50 for each one-way commute, or $3 long round trip the employer can reimburse the employee for. You can use this method if the employer-owned vehicle is provided to the employee for company business, and de minimis personal use is not going to be counted. If you stop for a personal errand on the way home, that's not way out of the way, then that is not going to be taxable. The employer must have a written policy prohibiting the employee from personal use other than commuting, and that de minimis personal use, that the employee doesn't use the vehicle for personal use, and the employee is not a control employee, director, officer with wages of $120,000 or more, or an employee with wages of just a regular employee of wages over $245,000, or owns more than 1% of the interest in the business. With the commuting rule, you are allowed to switch which valuation method you're using as of the first day that you stop using the commuting rule. Then there's the cents per mile. This is normally the standard mileage rate that is not out yet. The cents per mile cannot be used if the vehicle's value when it's available to the employees is more than $56,100. So if you've got a very expensive vehicle, say a $600,000 or $60,000 vehicle, you cannot use the cents per mile method. The cents per mile, or that $56,100 fair market value, is on the day that you make that vehicle available. So for personal, the standard mileage rate for 2022 is 58.5 cents from January through June, and 62.5 cents from July through December per mile. And what's included in the cents per mile is the cost of maintenance, insurance, and fuel. If you make your employees pay for their own fuel, then you can reduce the rate by 0.055 cents per mile. Again, the 2023 standard mileage rate is not yet available. To use, again, the cents per mile method, the following conditions have to be met: that the employee regularly uses a vehicle for business purposes throughout the year, or at least 50% of the mileage is business, or the vehicle is generally used each workday to transport at least 3 employees to and from work in a commuting pool. And then the mileage test is met. The vehicle is driven by employees at least 10,000 miles per year, business and personal combined, and it's primarily used by employees. And there is a consistently requirement that you must begin using the cents per mile rule on the first day you make the vehicle available. You must use the cents per mile rule for all later years in which you make the vehicle available and the vehicle qualifies. You must continue to use the cents per mile method if you provide a replacement vehicle to the employee and the vehicle still qualifies for that rule, meaning it's under $56,100, and your primary reason for the replacement is to reduce the federal taxes. And there are some additional issues relating to the commuting rule if you look at publication 15B. And the item included in the cents per mile is maintenance and insurance. You can switch to the lease value on the first day that the automobile no longer qualifies for the cents per mile rule. So if you do get a new vehicle that the employee is going to use and it's over that $56,100 limit, then you can switch to the lease value rule. Otherwise, once you start using cents per mile, you're going to have to continually use cents per mile, which means when the employee uses the vehicle for personal use and you're reimbursing them, that reimbursement is taxable at the standard mileage rates. The annual lease valuation, this one's more popular because most vehicles nowadays are kind of expensive. So this is determined on multiplying the annual lease value of the car by the percentage of personal miles driven. So again, here you're going to determine the fair market value of the vehicle on the first day it was made available to the employee for personal and business use. The fair market value is the amount the person would pay to buy it from a third party in an arm's length transaction in the area that the automobile is bought, the area that the employee is going to be using it in. So if you were to go to a dealership and buy a vehicle, like I'm in Green Bay, if I were going to go to the Honda dealership and buy a vehicle there, that's going to be my fair market value. The fair market value also includes any purchase expenses like sales tax and title fees. So that's all included in that fair market value. And so that would be my fair market value of that vehicle. If I go down to Minnesota or out to Minnesota and buy a fair market vehicle or buy a vehicle for use in Green Bay, Wisconsin, well, then I'm going to have to get a Kelley Blue Book estimate on the fair market value, because with Kelley Blue Book, it's in the area. You've got to specify the area that you're using it in, and that you can use then as the fair market value. There is an IRS annual lease value table, which we'll see in a minute. And what you're going to do is you're going to calculate the percentage of personal miles driven, and then you're going to divide it by the personal miles. And if you provide fuel, that is actually taxable also to the employee at 0.055 cents per mile. And there is a spreadsheet that we'll see in a minute on how to calculate this. If you choose to use the annual lease valuation method, you have to use it beginning on the first day you make the automobile available to the employees for personal use. You've got to use the rule for all later years that you make the automobile available to that employee. And you must continue to use the rule if you provide a replacement automobile to the employee. Again, publication 15B has more information regarding the commuting rule and annual lease valuation. The items included in this annual lease valuation is the value of maintenance and insurance. It does not include the value of fuel you pay for or provide. So if you do pay for fuel, you must include that fuel as a separate addition to the employee's wages, either at fair market value, meaning what you paid for that fuel, or at 5.5 cents a mile. Any use of that vehicle that isn't substantiated as business use is included in income. So if your employee doesn't give you any type of log that says, okay, these are my business miles and these are my personal miles, if you don't have that substantiation, the whole use of the vehicle is considered taxable to that employee. So that's why you have to have substantiation. Here's the lease value table. Again, this is available in publication 15B, and it just says what your annual lease value is depending on what the fair market value of the vehicle is. Any vehicle that is over $59,999 is at a separate, you've got to calculate that separately, and it's 25 cents times the automobile's fair market value, and then you add $500, and I'll show you a sample of that. So here's an example of personal use of vehicle, and this spreadsheet is also available in the handout. It is one of the tabs, and what this does is it shows you how the calculation, well, you just have to put in some numbers and it'll calculate what your fair market value is that you need to add to the employee's W-2. So on this 2022 Suburban that Pat drives, I paid the employer paid $93,220 for that vehicle. Well, that amount is not in these tables. It's over the $59,999. So I have to manually calculate the amount times 25 cents, and I come up with $23,305, and then I add $500, and the annual lease value is now $23,805, and that's what I put in on line 14 for the annual lease value from the table. So here is the annual lease values. Here's my business miles versus my personal miles. The spreadsheet will calculate the personal use. You have to watch if you buy a vehicle during the year, you're going to prorate that. So, if halfway through the year, Dawn got a new vehicle and no longer drives the Tundra, she has personal use of vehicle for the Tundra for, say, 200 days out of the year, and then got a different vehicle that her employer got for her, and that's going to be at 165 days out of the year. So you're going to have to, know when you got a second vehicle or a newer vehicle for an employee and plot the number of days in on that cell. So this spreadsheet will calculate what the personal annual lease value is. And then you go down to, is fuel provided by the employer? And again, if it is provided by the employer, you have to add that again as a fringe benefit to the W-2. So if it's at fair market value, so you provide all the fuel or you have the fuel bills, you're just going to put in the number of the fuel, the amount of money you spent for the fuel. Or if you're using the cents per mile, you're going to put in the personal mileage. So that pretty much explains the personal use of auto with the lease value calculation. Then if you need to gross up the amount, which most people have to do, if I look at Pat, who drives the 2022 Suburban, his fringe benefit for the vehicle is $461. Well, if I add $461 to the paycheck, that's going to decrease the amount he's actually getting the fringe benefit on. So you're going to want to gross up that amount, and there is a little table down here that grosses up the amount. So the amount you're going to put on this W-2 is actually going to be $499.43, so it nets out to the $461.22. Group term life is the other one fringe benefit that I see quite often, and this is non-taxable for the first $50,000 of coverage. So if the employer provides group term life to the employees, as long as it's under $50,000, you don't have to worry about it. But it is only non-taxable if it's under that first 50, and it provides a general death benefit that is not includable in income. It is provided for a group of employees, more than 10 employees, even if not all the employees choose the benefit. It provides an amount of insurance to each employee based on a formula that prevents individual selection, so it can't discriminate. And it's provided under a policy that the employer either directly or indirectly carries. And what that means is if the employer is carrying it, it means even if the employee pays 100% for it, if that money the employer writes a check out to the insurance company for, it's still considered an employer policy, even though the employee might pay 100% for it. The amounts over $50,000, it's going to be taxable income. And it's taxable for Social Security and Medicare, federal withholding. The employer does not have to withhold federal withholding and state withholding. A lot of times they don't, just because it's easier. And any group term life is not taxable for FUTA and SUTA, for federal unemployment and state unemployment. Group term life goes in the box 12 of the W-2 with the code C. And if there's less than a full month of coverage, you can prorate that. And again, if it's a 2% greater S Corp shareholder, it's all includable in wages. It's non-taxable to the employee, so it's not treated as a fringe benefit if the beneficiary of the policy is the company that the employee works for, If the beneficiary of the policy is a charitable organization for the entire year, or the employee terminates during the year due to a permanent disability, then the group term life would not be considered taxable. So calculating the excess group term life, what you need to do is figure out the excess, the amount over $50,000, then divide that by 100. So if my policy was $120,000, $70,000 of that would be considered fringe benefit. You're going to divide that by 1,000. So then I'm at 7,000. And then determine my age as of 12/31, and I'm not going to tell you that. Then you're going to multiply by the rate found in publication 15B, and then deduct any after-tax employee contributions. There are additional rules for spouse-dependent group term life and former employees group term life. And again, if you have those situations, you're going to want to look at publication 15B. So here's the table of the cost per $1,000 of protection for 1 month for the employees. And as you can see, as the employer gets older, the cost goes up. And on our next slide, we're going to see the calculation. And again, this is included in the handout. So what you're going to do is list your employee's name. If you want, you can put the date of birth and the date of hire. But the one thing you do need is the age they are at the end of the tax year. In this case, it's 1/31/22. You put in their amount of group term life insurance, and then the spreadsheet will calculate the thousands over 50, the cost per 1,000, and then the subtotal. Then you put in the number of months the employee was covered under that plan. And if the employee paid any premiums, you're going to enter that in. And at the end, at column K, you're going to see the net that you need to include in the employee's wages as the fringe benefit for group term life. If you need to gross that amount up, there is a column M that'll give you that calculation. If the employee pays with after-tax dollars, it's going to reduce the amount that's included in income, which is your column A. Column B is the net amount, and then column C is the grossed up value, as you can see down below. If your employee is or will be over the FICA limit, you're going to need to make an adjustment for that. And if the employee is going to be over the Medicare limit of the $200,000, you're going to have to make an adjustment for that also. So those are some things to take into consideration when you're doing the gross up. Moving expenses. Moving expenses used to be a pre-tax benefit as of January 1st of 2018. They are no longer a tax-free perk, and it's supposed to be expiring on 12/31/25, so they may make it a tax-free perk again after that point in time. We'll just have to see. Members of the armed forces that are on active duty and who move because they're a permanent change of station, they are excluded from this as long as the employee did not get reimbursed. So there's a separate publication on that. If you do have somebody that is in the armed forces, you're going to want to look at publication 3 at the IRS website. Education assistance, certain job training, job-related education can be provided as a tax-free benefit. To be tax-free, it's got to meet one of the following tests. The education is required by the employer or by the law for the employee to keep his or her job at their present salary and at their present status. And the required education must serve a bona fide business purpose to the employer. And the education maintains or improves the skills needed in the job. If the deduction tests are not, even if those education requirements are met, it isn't going to be considered qualifying education if it's needed to meet the minimum educational requirements of the employee's present trade or business, and if it is part of a program or study that will qualify the employee for a new trade or business. So if it's, for the employee getting a degree that's going to maybe move them up the company ladder, then it is not going to be a pre-tax benefit. It's going to be taxable to that employee. If it's going to be an education benefit that, keeps the employee where they are and they need it for their job, then it's going to be tax-free. But if they're going to be able to get promoted as that with that education, then it is not tax-free. Business travel, meal, entertainment, gifts, transportation. Under an accountable plan, the allowances or reimbursements paid to the employee for job-related expenses are excluded from wages and not subject to withholding. Accountable plan means that the employee accounts for those expenses. So they're going to give you an expense report with receipts. They're going to say, these are my miles. Here's my hotel bill. This is how much I spent when I took the client out for dinner. So it has to be accountable. They're going to give you the information. Then it's tax-free to the employee. It's got to be a business connection to the expense. There's got to be adequate accounting by the recipients within a reasonable period of time. So that means if I'm taking a client out to lunch, I need to turn in that expense sheet within the time period that my employer tells me what it is. Any excess reimbursements have to be returned to the employer within a reasonable period of time. If you don't return those expense advances or expenses, say your employer gave you $100 to take your client out and you only spent $80, the $20 has to go back to the employer, otherwise that $20 is taxable to you. A non-accountable plan is an allowance or reimbursement that does not meet the requirements above. It just means, you get reimbursed, you're not providing receipts or anything like that. That is going to be fully taxable to you. And then any expense that is lavish or extravagant is not allowed. So even if it is a meal at, a 5-star restaurant somewhere and, you're getting the lobster and caviar and things like that, that would be considered extravagant. Business travel. There is now a special per diem rate that can be used to substantiate the amount of business expenses incurred for travel away from home. And this is available after 10/1/22, where the per diem rates, which I have published, or I've got the website that the per diem rates are going to be found at. The employers can use the rates set out in the per diem allowances in certain categories and travel expenses as substantiated without requiring the employees provide the actual amounts they spent. The employees still should substantiate the time, place, and business purposes of their travel. But if you're giving them a per diem allowance, they do not have to keep those receipts. And that is only if you are using the per diem rates. And the per diem rates are going to change based on where that employee is traveling to. Wisconsin has a per diem rate, but if you're traveling to, say, the Wisconsin Dells area, their per diem rate is going to be higher than just Wisconsin's. Or if you're going to New York, if you're going to Buffalo, New York, that per diem rate is going to be different than if you're going to Dunkirk, New York. So you've got to look up your per diem rates on this website. The per diem is a combination of federal lodging expense rate and the meals and incidental expense rates. So that is what is included in a per diem. Mileage reimbursement is not taxable up to the federal standard mileage rate as long as it is substantiated. Any reimbursement over that rate is taxable, and the employer is allowed to pay under that rate. So the mileage rate for 2022 we talked about before is one rate from January through June, the other rate from July through December, and we don't know 2023's rate yet. But I've seen employers say, okay, I'm going to pay you 50 cents per mile. I'm not going to pay you the standard mileage rate, and that is acceptable. If you do put on a lot of miles, that is unfortunate. It used to be that you could claim the difference, but that tax form is no longer available. Employee loans, I see way many of these. If an employee's been with you for a long time, run into hard times, sometimes they will ask for a loan, and I've seen employers get burned on this. but I've seen employers also get repaid. So that as an employer, that's up to you. The loans that are real loans should have interest on them. And there's the applicable federal rate is the loan rate that you should be charging for loans that are more than $10,000, or any difference is taxable that the loans get more than $10,000. The taxable amount of loans is subject to Social Security, Medicare, FUTA, and SUTA, and the AFR can be found at the website I've listed. So loans under $10,000, there's no imputed interest unless the principal purpose of the loan is tax avoidance. There's no imputed interest on the loan for relocations to a new principal place of work, and there's no imputed interest on advances repaid within the reasonable amount of time. Proper documentation of the loan is important. And again, you can find out on the internet, you can find loan, like in legal documents, you can find a loan guarantee or something like that, that you can have an employee sign. The employer's cancellation of an employee loan results in cancellation of indebtedness income, and it's not compensation. That canceled loan would be reported to the IRS on Schedule 1099-C. Prizes and awards. These are tax-free if you're doing them in the correct way. So there's achievement and safety awards. They can be given to an employee for length of service or employee achievement or a safety achievement. The award has to be a tangible personal property, something that you can touch and feel and see. It can't be cash equivalents, gift cards, stocks, vacations, meals. The award is giving in a meaningful presentation. What that means, I don't know if it means you're having everybody in the lunchroom and you're giving the award at that time, or it just has to be a meaningful presentation. I haven't ever seen a description of that on the IRS website, but my thought of a meaningful presentation is getting together at lunch and saying, you know, we're giving Joe an award for not having any safety accidents. And the award is not disguised as compensation. The length of service award is excluded from income. Yeah, if the employee receives the award during the first 5 years of employment and the employee didn't receive another length of service award during the same year or in any of the prior 4 years. The limit is $400 for awards under a non-qualified plan. We talked about qualified plans and non-qualified plans. And there is a limit of $1,600 for all awards in a calendar year, whether qualified or not qualified. Back pay and legal awards. Back pay awarded to a taxpayer constitutes wages and is reportable on their W-2 form in the year that was paid. Awards for punitive damages, non-physical injury, or sickness, discrimination, or defamation is considered income, but they get reported in box 3 of Form 1099 Miscellaneous. So those are a couple things that you want to keep in mind. Jury duty pay. Any pay by the employer above and beyond payment from the courts is taxable. And if the employer requires the employee to turn over their jury pay, the difference between the amount paid for jury paid and the amount turned over is taxable. Tips are taxable income. It does not include allocated tips, which are reported in box 8 of Form W-2. Earnings of more than $20 a month in tips must be reported by the employee to the employer by the 10th of the following month, or the employer may require it more often. It should be reported on Form 70 or 4070 or in a similar statement. It's just an employee's report of tips to the employer. So if the employer has another type of statement or form to fill out, that's what they would require. Service charges are not tips, but those are wages. These charges are, a service charge is added to a customer check without the customer having a right to determine the tip line. So you'll see on menus saying parties of 10 or more will be charged a service charge of 10% or whatever it is. That is a service charge and that is not considered a tip. So the line large dining party automatic gratuity, which I just mentioned, A banquet event fee, a cruise ship package fee, bottle service charges, and hotel room service charges are not considered tips. Gift cards are always taxable. They always have a specific value, and they're not unreasonable or administratively impractical to account for. They're always going to be taxable. Employer provided cell phones. These are no longer a fringe benefit. They're just always tax-free. So the employer provided cell phone, I should say it's always going to be tax-free if the employer wants to contact the employee at all times. That's why they have a cell phone provided by the employer. The employer requires the employee to be available to speak to clients at times when the employee is away from the office, or the employee needs to speak with clients located in other time zones outside the normal workday. So normally having an employer provided cell phone is not a big deal. It's not taxable. Adding fringe benefits to your pay. So if a fringe benefits are entered with a regular payroll, taxes get calculated, so it might not be necessary to gross it up. Federal and state income tax withholding is not required, so you just have to make sure you're paying your FICA. If the fringe benefits are entered after the final payroll, it will need to be grossed up. Again, you're going to be careful of the Social Security limits and the Medicare limits. Fringe benefits should be added to box 1, 3, 5, and 16 on the W-2 and listed in box 14, or give the employee a separate sheet of paper explaining what the fringe benefits are that were added. There are some de minimis fringe benefits that are not taxable to the employee. According to the IRS, the fringe benefit is any property or service provided to an employee that has so little value that taking account into how frequently you provide the benefits, that accounting for it would be unreasonably or administratively impractical. Again, cash and cash equivalents are never de minimis. Occasional meal money, transportation fee might be considered de minimis. Some examples of de minimis fringe benefits where you don't have to tax the employee is occasional use of a personal use of an employer's copy machine, occasional group meals, picnics for the employees, traditional birthday or holiday gifts of property, not cash, with a low market value, occasional theater or sporting event tickets, coffee, donuts, soft drinks, local telephone calls, flowers, fruit, books, similar property provided to the employees under special circumstances. So those you do not have to tax the employee for. Now we'll talk about independent contractors. Employee versus independent contractor. So you want to make sure you're differentiating these. An employee is someone whose employer controls when they work, how they work. The employer supplies the tools and the know-how for the job, and an employee is going to have benefits, PTO, health insurance, retirement plans, vacation, things like that. That is an employee. An independent contractor is not an employee. They're somebody that operates their own business. They work for you, and they probably have a contract that states, how long the project's going to go on for, what happens in the event that the project is not completed satisfactorily. They don't get reimbursed for gas or supplies, and they pay in their own FICA and other taxes. There's some federal tests to differentiate if they're independent contractors or employees. So it's all on the degree of control and independence. So it's behavioral. Does the company control or have the right to control what the worker does and how the worker does it? Financial. Are the business aspects of the worker's job controlled by the payer? Things like how the worker's paid, when they're paid, expenses being reimbursed, who provides the tools, and the type of relationship you have. Are there written contracts, employee benefits? Is the relationship going to continue, and the work performed is a key aspect of the business? Those are some common law rules that federal will look at. Wisconsin and Minnesota requires 9 different tests to determine if you're an independent contractor. Maintaining a separate business, maintaining a federal ID number, or have filed a business or self-employment income tax return with the IRS based on the worker's service in the previous year. For Wisconsin, a social security number cannot be substituted for a federal employment ID number. So if your subcontractor does not have a federal ID number in Wisconsin, Wisconsin could say, well, you know what, you're an employee then. It's very easy to get a federal ID number. You just go on the IRS website and you can get it within 5 minutes. So if you're an independent contractor, you want to get that federal ID number. It's also a security issue because as an independent contractor, you don't want to put your social security number on any type of documents like W-9s. So again, get that federal ID number. They also look, Wisconsin and Minnesota also look if they're operating under specific contractors, if they're responsible for their own expenses, if the job has to be satisfactorily completed for work or services, if they receive compensation under a contract per job by commission or competitive bid, if they have the opportunity to realize a profit or suffer a loss, recurring business liabilities or obligations, relationships of business receipts and to expenditures. And I do have the websites of these 9 different requirement tests for both Wisconsin and Minnesota listed. So if you are hiring an independent contractor, you want to have that contractor fill out a Form W-9. You want to request also a certificate of insurance for workers' comp and general liability, just to make sure that that subcontractor or independent contractor is covered under insurance, because otherwise you're going to be responsible. If you pay an independent contractor over $600 in a calendar year, you have to issue them a 1099 miscellaneous form or a 1099 NEC, which is non-employee compensation. If you've missed an employer issuing one of those forms, you could get penalized. And the penalties are calculated based on when you file the 1099 return, and it can range from $50 per form to $550 per form. It's good practice to get the information from all vendors that you're working with. And if the independent contractor fails to furnish their taxpayer ID on that W-9 form, you have to withhold 24% as backup withholding that gets paid into the IRS like a 941 payment would. So a best practice for getting that W-9 form is asking the vendor to fill it out, and once they get it back to you, then you will pay the vendor for their services. By doing that, it ensures that they'll complete the form, which you need for tax purposes for issuing the 1099 miscellaneous or 1099 NEC. When you get that form, just do a quick review and make sure the boxes are checked and the taxpayer has signed the form. And here's just a sample of Form W-9. Again, it asks, one thing when you're having your vendor fill this out, line 1 is the name as shown on your income tax return. So if it is a independent contractor that is not a corporation, it's just a sole proprietor, it's normally going to be their name that is on the tax return, and the business name is going to be on line 2, because if they file just on the regular 1040 and file a Schedule C, you're going to want to put their name on line 1, and then in that case you're going to need their social security number. If they are actually a business or a partnership or an S corporation or C corporation, then you're going to have their federal ID number and the name of the business that's shown on the tax return, because then they're going to have to file a separate tax return for the business. And when you do file those the 1099 forms, if the name on the form does not match the tax return, you're going to get a matching notice from the IRS saying, okay, you've got a business name with social security number, and it should be the individual's name, or you should have a federal ID number instead. There is some relief if you miscategorize an independent contractor. If they, really should have been an employee, you want to request Section 530 relief. And I've had a client that has done this, and it greatly reduces the penalties, because if the IRS or somebody were to come in and audit your employees versus independent contractors and find that those independent contractors should have been employees, they will get you for not reporting their wages on a 941, for late payment of 941. Penalties regarding those. You're going to have to file unemployment returns, penalties with those because you're late paying. So it can get to be a very costly issue if you get caught paying an independent contractor versus paying them as an employee. So Form 1099 Miscellaneous, you're going to fill out as a business person. If as a personal payment, those aren't reportable. So if I pay Jim to paint my house, I'm not going to send Jim a 1099 because he's doing that for me. As a business, if Hawkins Ash hires Jim to paint the office, then Hawkins Ash is going to give Jim a 1099. So the 1099 miscellaneous form you use for at least $10 or more in royalties, or if you pay somebody at least $600 in rents, other income, federal income tax withheld, fishing boat proceeds, medical health care payments, payer made direct sales totaling $5,000 or more, substitute payments in lieu of dividend or interest, crop insurance proceeds, gross proceeds paid to an employee, paid to an attorney as a settlement agreement, fish purchased for resale, Section 409A deferrals, excess golden parachute payments, and non-qualified deferred comp. Normally, a corporation is not going to get a 1099 form, but if they're a corporation and they are medical and health care payments, then you are still going to send them a 1099. And if they're a corporation and you've got gross proceeds paid to an attorney, you're still going to give them a 1099. And substitute payments in lieu of dividends or tax exempt interest, even if it's a corporation, you're still going to give them a 1099. And here's the 1099 MIS form. Then there's also the 1099 NEC, the non-employee compensation. So non-employment compensation is payments that are at least $600 performed by someone who is not your employee. You're going to include in that total parts and materials. An NEC is also payments to an attorney for legal services, even if they are a corporation. Cash payments for fish or other aquatic life if you purchase from anyone engaged in the trade or business of catching fish. Barter transactions, which are exchanges of services between individuals in the course of trade or business. And nonprofit organizations are subject to these reporting requirements. And here's the 1099 NEC form. Now we're going to talk about the Affordable Care Act. And this applies to all U.S. employers having 50 or more full-time or full-time equivalent employees in the calendar year, in the previous tax year. If you have a company that has affiliates that are commonly controlled, it is normally considered one employer for the ACA. The following persons and entities that provide minimum essential health coverage during a calendar year are required to file 1095 forms. Health insurance issuers, carriers for all insured coverage, plan sponsors of self-insured group health plans, executive department or agency of a government unit that provides coverage under a government-sponsored plan, and any other person that provides minimum essential coverage to an individual. It's used to determine whether the employee is eligible for a tax credit if they purchase their health insurance on a marketplace exchange, and whether the ALE, applicable large employer, is subject to a penalty under the employer shared responsibility provisions. And they have been policing this. So if you do have more than 50 full-time or full-time equivalent employees, you definitely want to look into filing those 1095 forms, because I've seen some pretty big penalties come through. You have to file Form 1095 that is issued by the Health Insurance Marketplace. Form 1095B is issued by the health insurance insurers and carriers. Form 1095C is issued by an employer to the employee who is a full-time employee of any month of the calendar year. The forms are required to offer affordable health insurance to their employees. These forms help regulate the requirement. The employers that fail to comply and fail to comply on time or fail to document face penalties. And we also have at Hawkins Ash a service that will help you complete your 1095 forms. Some miscellaneous things. Prior to doing your first payroll of 2023, you want to just review any changes on health insurance premiums, HSAs, pension plan contributions. In your software, you want to make sure that you enter your new state unemployment rate. If you have any employees that claim exempt from withholding, you need to get new forms every year. So if an employee claims exempt, you need to have a new W-4, WT-4, W-4 Minnesota. Those have to be completed each year then. Verify if there's any new benefits that are going to be offered. And verify that first payroll by manually calculating some of the payroll taxes. Record keeping, keep documentation of your records for 7 years in the event of an audit. We do have a retention guide out on our website that will, kind of tell you if it's payroll, you should keep it this long. If it's bank statements, you should keep them this long. And a little about Hawkins Ash. We have 10 different locations. I do have all of our phone numbers listed on this slide. So if you are in one of the vicinities and have any questions on any of the information, you can call your local office. And with that, we're finishing 2 minutes early, and I haven't seen any chats come through or questions. So I am hoping I covered everything you needed to hear, and I hope you enjoyed the presentation today. Again, you've got the slides and the spreadsheets in the handout section of this webinar. I thank you all for attending and hope you have a wonderful afternoon. Bye.